Okay, class, today we're going to be talking about international capital markets. So, capital markets are a group of markets that trade different types of financial physical assets. These include stocks, bonds, deposits, commodities, forwards, futures, swaps, and options, real estate and land, and factories and equipment. So we have gains from trade. When a buyer and seller engage in a voluntary transaction, both receive something that they want and both can be made better off. They can trade goods or services for other goods or services for assets, or assets for assets. So here's the three types of international transaction. So we have the theory of comparative advantage, which describes the gains from trade. With a finite amount of resources and time, use those resources and time to produce what you are most productive at compared to alternatives, then trade those products for goods and services that you want. Be a specialist in production while enjoying many goods and services as a consumer through trade. Next, we have the theory of intertemporal trade, which describes the gains from trade of goods and services for assets of goods and services today for claims in the future. Savers want to buy assets, borrowers want to use assets to consume. Savers earn a rate of return on their assets, while borrowers are able to use goods when they want to use them, so they can both be made better off. We have the theory of portfolio diversification. This describes the gains from trade of assets for assets, of assets with one type of risk for assets with another type of risk. So investing in a diverse set or portfolio of assets is a way for investors to reduce or avoid risk. People usually display risk aversion. Suppose that two countries have an asset of farmland that yields a crop depending on the weather. The return on the asset is uncertain, but with bad weather the land can produce 20 tons of potatoes, while the good weather the land can produce 100 tons of potatoes. So the expected value of the yield is 60 tons. So suppose the historical records show that the domestic country has good weather, high yields, the foreign country has bad weather, low yields. We can assume that the future will be like the past. So the two countries could avoid suffering from the bad crop by selling 50% of one's assets to the other party and buying 50% of the other party's assets. This diversifies the portfolios of assets so that both countries always achieve the portfolio's expected average value. So with diversification, we can enjoy a moderate potato yield and not experience the shocks of feast and famine. If both countries are risk averse, then both countries could be made better off through diversification. So next we have the clarification of assets. We can classify assets either as debt instruments, which are bonds and deposits, or equity instruments, which are stocks and titles to real estate. They specify ownership of variable profits, which vary according to economic conditions. Debt instruments specify that the issuer must repay a fixed amount regardless of economic conditions. So we have international capital markets. Participants are commercial banks and depository institutions. Non-bank financial institutions such as securities firms, pension funds, insurance companies, and mutual funds. Private firms. Corporations issue stock, they issue bonds, and they may borrow to acquire funds. And central banks and government agencies. Central banks sometimes intervene in foreign exchange markets. Government agencies issue bonds to acquire funds and may borrow from commercial banks or securities firms. So next we have offshore banking. This refers to banking outside of the boundaries of a country. There are three types of offshore banking and are regulated differently. The first is an agency office in a foreign country, makes loans and transfers, but it does not accept deposits and is not subject to depository regulations in either country. Next is a subsidiary bank, which follows the regulations of the foreign country, not the domestic regulations. And then we have a foreign branch of a domestic bank, and it's subject to both domestic and foreign regulations. Offshore currency trading. We have an offshore currency deposit, which is a bank deposit denominated in a currency other than the currency that circulates where the bank resides. This may be deposited at a subsidiary bank, a foreign branch, a foreign bank, or another depository institution located in a foreign country. These are sometimes confusingly referred to as euro currency deposits because historically they were made in European banks. Offshore currency trading has grown for three reasons. One is growth in international trade. Second, which is the biggest, it's called tax flight, which is the avoidance of domestic regulations and taxes. And third is political factors, to avoid confiscation by a government because of political events. So if you think your country is about to go through a coup or a revolution or a civil war, you're likely to stash your assets offshore so they're not going to be obfuscated. So next we have reserve requirements. Here's the primary example of a domestic regulation that banks have tried to avoid through offshore currency trading. So we have regulation of international banking. Banks fail because they do not have enough of the right kinds of assets to pay for their liabilities. In money countries, there are several types of regulations to avoid bank failures or its effects. So we have banking and financial fragility. It's a pretty fragile system. So government safeguards. First is deposit insurance. This ensures that depositors against losses up to $100,000 in the US when banks fail. This prevents bank panics due to a lack of information. But it creates a moral hazard for banks to take excessive risk. Moral hazard is a hazard that a party in a transaction will engage in activities that would be considered inappropriate according to another party who is not fully informed of those activities. Reserve requirements. Banks are required to maintain some deposits on reserve at the federal bank in case they need cash. Third is capital requirements and asset restrictions. If higher bank capital means banks have more funds available to cover the cost of failed assets. And we have bank examination. This is a regular examination that prevents banks from engaging in risky activities. Then we have the lender of last resort. In the US, this is the Federal Reserve System. This prevents bank panics and acts as insurance, but it also creates a moral hazard. So basically, if you know that you're insured for something, you're more likely to engage in the risky activity. So we have government organized bailouts. So failing all else, we might organize the purchase of a failing bank by healthier institutions. In this case, bankruptcy is avoided. So all of these safeguards alone were not sufficient to prevent the financial crisis of 2007. So let's look at the frequency of systemic banking crisis from the 1970 to 2011. So let's look at some difficulties in regulating banks. First is deposit insurance may not be large enough. Second, reserve requirements act as a form of insurance for depositors, but we can't impose these requirements on foreign currency. So, first, for banking examination, distance and language barriers make monitoring difficult. And we also have an issue with jurisdiction. So, in the international field, there's no international lender of last resorts. The IMF kind of acts like this, but it's not totally like this. And derivatives and securitized assets make it harder to assess financial stability. So we have this trilemma. So first is deposit insurance is absent in international banking. Financial trilemma constrains what policymakers in an open economy can achieve. The first goal that they try to achieve is financial stability. The second is national control over financial safeguard policy. Third is freedom of international capital movements. So we had the Basel Accords. They provided standard regulations for accounting international financial institutions. Then they tried it again with Basel II. Then there's an even tougher set with Basel III. So the macroprudential perspective. Ensuring that each individual financial institution is sound will not ensure that the financial system as a whole is sound. So there's intense lobbying from home financial institutions that argue that stricter rules would put them at a disadvantage to relative foreign rivals.